mark wherein everybody is concerned why we continue to purchase internal audit or audit services when we haven't had a significant issue in years. This is something which has come up as a challenge, and I think the 2 decades that I have spent in my career, I still recall early days of my career back in early 2000s. Internal audit used to be more focused on processes. Then it moved to internal controls with Sarbanes and other things coming into picture. And now it has moved into the niche regime of what value internal audit brings to table. So if you look at it, typically auditors also have to present a value add statement, and they have to satisfy the audience that there is a value now. If you look at the definition of internal audit, which has been put up by ICAI as part of FAQs, internal audit provides independent assurance on effectiveness of internal controls and risk management processes to enhance governance and to achieve organizational objectives. I think the key thing here is looking at achieving the organizational objective, which is critical, and which is where internal auditors need to play a pretty large role and fill in large boots. Today's agenda, we will be discussing value addition, uh, how to add value, what are the objectives during our internal audit review, how it has evolved, what are different focus areas for internal auditors, transformation to stuff like analytics, and we'll briefly also touch upon agile internal audit. So this is one slide which essentially talks about value addition. What is value addition all about? Why is it relevant? Value addition can be whether it is tangible or intangible. Tangible value can be in terms of monetary terms, what value you bring to the table. Intangible value will be something like how you are helping organization to either improve their brand, looking at how they are improving their reputation, maybe improving the goodwill. And those are some things which are not quantifiable in terms of value, but then yes, it has a touch point. It can be even as basic as ensuring that the valuation of our business goes up because of good business practices involved. Why is it relevant? I think first and foremost, in today's time, pandemic has raised a situation of looking at cost very carefully. Also, there is significantly increased pressure of competition. There is a significantly increased pressure on cost. There are existential issues involved, and this is also relevant from the perspective of esteem and being relevant to the businesses. Today, the single largest point for any organization, and this spans across smallest of the lot and largest of the lot. There is huge push on ensuring that you are up above your competition and your costs are bare minimum. So when an internal auditor looks at the costing, he can be looking at avenues of reducing financing cost, reducing cost of manufacturing. Frankly speaking, when I go and do internal audit, one of the key things that I do is look at manufacturing operations and look at avenues of ensuring that my cost of manufacturing goes down, or how I can improve the efficiency of business. It can also be as varied as logistics, can be as varied as how you are improving your procurement strategies, and so on and so forth. Similarly, when you're looking at being relevant, am I producing a product which is not selling in the market today? So for example, if hypothetically, if you look at the case of a textile business like Raymond's selling yarn is different than Raymond selling ready-made shirt. In the times of pandemic, when you know that past 8 months all of us have been working from home, and next many months we will be working from home, the usage of shirts has gone down. So is it really relevant to produce those things? Similarly, looking at if you look at the case of perfume manufacturers, most of the perfume manufacturers have now transitioned to selling sanitizers, because both can be made in a similar way. It's only a mix of chemicals which can vary. So internal auditor should also look at those aspects. Am I doing, or is the business doing something which makes sense to them? So those things need to make sense. The second part of it is, what do stakeholders expect from internal audit? There are four different stakeholders that an internal auditor has to deal with. First and foremost, in today's environment, is the different statutory bodies or regulators or statutory auditors. Second is the one which appoints them, which is audit committees or the board of directors. Third is the functional management, which is essentially a C-suite, CEO, CFO, MD, or different HODs. And fourth, which are the most critical ones from the perspective of doing internal audit, that is process owners. Ultimately, without these guys, you cannot really do the audit. So each of these guys have their own different perspective on how or what they want from an internal audit. Typically, a process owner wants genuine observations, not something which you have just heard from them and reproduced on a piece of paper. They also need to like to look at what is the process understanding you have brought to table. Have you understood their point of view? What are the different suggestions that you are bringing to table? And are you also, besides pointing errors, also appreciating the good work? The functional heads, CEOs, CFOs, CIOs, MDs, what they look for is what is the value add which can impact the business, how clear and concise the observations are, is it giving the fair view of overall risk assessment, and it's a balanced view of presentation. It is not that you are broadcasting the observation. I still remember in my early days, one of my large clients used to very clearly say, uh, why do you put headers on top of observation? It takes away the focus of audit committee and the board from my observation to other things. And the focus is uh, you're just writing one line which washes away the whole effort of all management. So your headers have to be very clear, concise, and need to be properly drilled down in terms of root causing and impact analysis. First, and also the critical part of having process or acceptance on the observations. Audit committees are typically looking at what is the coverage, what is the risk assessment, what is the value you're bringing to the table, and one thing which I don't think we have mentioned on the slide, what is the status of compliance to the observation? It is not that you're only creating a repository of the observations and forgetting about it. The external auditor or the other regulators, what they look for is overall coverage. What is the impact on the true and fair view of the accounts, any kind of regulatory non-compliances, and assurance on which they can rely on. So those are key things which an external auditor would like to look at. Now, moving on to the next slide, how to add value. There are different ways in which a typical internal auditor can add value. So one is developing and launching a brand identity, linking advisory services to assurance. Also moving away from the financial statement review to more of a focused process and cyber reviews scenario, which can add more value to the business. Today in my different internal audits, the work that I do as part of internal audit is only 1/3 financial statements relevant, and 2/3 is more dependent on what I do as part of cyber and other business things. looking at end-to-end risk management. And risk management is not only the financial risk management, it actually encompasses the 16 or 17 different sectors. So it is essentially moves from the external factors which may be relevant to business, looking at internal factors, and then moving into the regulatory aspects of it. So all of it needs to be covered as part of annual internal audit plan. It may be annual plan or as a plan split over 2 or 3 years, but it should be there. Looking at the efficacy or adequacy of strategic planning process. In certain cases, also
I think Mixer's connection has just gone off. Internal audit, is something which is being focused on in all these seminars, and we are having separate sessions for internal audit. So, I think Amit sir gave a very good background about what is it that we as internal auditors need to look for while we are thinking of adding value to the business. And as I mentioned, as per the definition of the institute and also otherwise, the critical aspect for internal auditors is to achieve organizational objectives. Um, there are a lot of times which we all must have faced where after internal audit review, the management has come to us and said that they probably did not get the value or the, I would say the feedback that they were looking for. They did not see the value coming in the internal audit report, and that is where it becomes really important for us to focus on the key objectives of any internal audit review. In today's time, internal audit is not only about giving an assurance to the management about the controls. Obviously, that becomes the primary objective of an internal audit. But apart from that, there are various objectives or expectations which the stakeholders expect from internal auditors. And as internal auditors, our focus should be protecting and enhancing those values while conducting the internal audit reviews. Here I have some of these objectives mentioned. So one of them is compliance to company policy, philosophy and policy. So as seen in the definition, achieving the organization objective is the primary responsibility of the internal auditor, and to review that becomes very important. While doing any internal audit, you need to make sure that every transaction or every management decision that we are reviewing is in compliant with the company philosophy. Anything which is non-compliant is something that the internal auditor should report on. So that becomes, a very critical objective during our internal audit reviews. The second one is comparison with the leading industry practice. Now, this is something which has really come up in the last few years, where repeatedly stakeholders are asking us to tell us that what they are doing compared to the peers in the industry. And that is where involving industry experts in our internal audit reviews, gathering industry knowledge becomes very important. If I'm doing an internal audit for, let's say, a automobile client, then the client would obviously, and the client management would obviously want me to tell them that what is it that they are doing wrong or different from the industry practices, because that is how they will improve and see value in our internal audit reports. If we give an internal audit observation saying that so and so reconciliation or record is not being maintained, That is one part of it. But if we are also able to demonstrate that most of the folks in the industry are doing it, that is where they will see a real value. Also, key, I would say, analytics or key data points where we can come up with figures in an internal report saying that their performance does not tally with the performance of the industry. That is where the industry sees a lot of value. If I talk about my own example, in one of our recent reviews, we actually reviewed their complete budgeting exercise and compared that to the figures of the industry and said that the budgeting exercise that they were doing in itself was wrong because they were, budgeting extra in some of the cost compared to the industry. Now, there would be one argument that it is difficult to have industry knowledge for all the industries, which I agree, and that's a challenge that internal auditors face. But I guess if we do primary research, talk to the folks in the industry, build connects, then we can get basic knowledge about the industry and what other companies do. That is why it is important to have a network of internal auditors also, people whom you can consult, so that you can bring these things to the table. The third one again is very important and something the management is looking for, and that was something which was shown in the slide which Amit sir also showed, was identification of possible cost leakages. For those who are in practice, whenever we uh, charge a certain fee to the client obviously expects us to return certain value of that fee, and that is where identification of such cost leakages is again a very important objective during our internal audit reviews. And our focus, apart from the assurance part, should always be to look for areas where we can identify possible cost leakages, or also identify areas where they can probably increase the revenue or their bottom line. So that is something that we have to focus on as internal auditors. And the fourth one, again, in today's time, very important, is focus on the fraud and business process risk. Obviously, as internal auditors, it cannot be expected that we'll be able to unearth each and every type of fraud, but at least identification of red flags and key risks which can lead to fraud is something which should be our objective. The fifth one is enhancement of operational and system controls. So again, while doing our internal audits, we should focus on whether we are really enhancing the system controls, whether we are, a simple example of that is if you're doing a review at a client who is using SAP, you could give them observations to functionalities of SAP is not being used or certain controls which can be automized. So these can be certain areas where internal auditors can focus on and help the stakeholders. Similarly, assurance on control design, focused approach on control validation, and opportunities for process improvement. These are pretty self-explanatory, which should be the objectives of internal audit. So while making our internal audit reports or presentations, we should always, or reviews, we should always have these objectives at the back of our mind and see whether we are ticking these boxes when we are, issuing our internal audit reports. If let's say we are not really focusing on these things and we are only providing an assurance or a checklist-based audit, then you would see issues where the management might not be very satisfied or happy with the work which has come out. So if the internal audit really keeps such objectives in mind, you would see a lot of value coming out of your internal audit reports. Moving on, I also wanted to present what has been the evolution of internal audit over time. Look, the way the businesses have been moving and the way the businesses have been changing and evolving, you have the whole digitization of businesses coming in, and you now have COVID, which is again changing the way businesses are. Similarly, the evolution of internal audit is also very important, and it is happening with the way the businesses are moving. If you look at the traditional internal audit steps or the audit steps that we used to perform, it was pretty simple where you would just confirm the audit objectives or scope with the stakeholders. You would develop enhanced audit scope basis whatever walkthroughs that you have done. You would initiate the audit testing and everything. You would test key hypotheses, you would test observation, test data and all that, and you would just communicate the result. This was pretty much the standard traditional audit steps. Now what has happened is that data analytics has come up big time with the internal audit. If you see, you would really hear these terms like data analytics, big data, and all that. The reason for that is that the companies are also moving to digitization, and a lot of data is being generated at each of these companies that we are auditing. And that is where it is important for internal audit also to evaluate and integrate data analytics as part of our internal audit reviews. And that is why you would see that apart from the traditional audit steps that we used to do, there's a thrust on data analytics, which is very important, where identifying what can be potential analytics, extracting and transforming the data, analyzing the data, and developing testing hypotheses with the audit team. These are the audit steps which are done as part of the data analytics, which are very important. Today, even the sampling, instead of doing the traditional random sampling or traditional certified sampling, interrogators should look for sampling basis the data analytics which has been performed on the data. That is where you would get more hits, you would get more observations. And there are so many tools which have come up now, things like Power BI, Tableau, and all these sort of things. And I have a separate slide on data analytics, which is very important for the internal auditors to focus on, to help visualize the data and present a storyboard to the management. Today, the management probably does not, or the stakeholders does not want to look at a blank, straightforward internal audit report which says that okay, we did 25 samples and in 5 samples we found these issues. Rather, what they want to see is whether we can cover the whole gamut of the transactions through data analytics and present them storyboards and visualize the results or the data. If you can present that to the management and then support that with the traditional audit steps, that is how a good internal audit report would look like, and that is what I think the management would appreciate. So data analytics is again very, very important, and something which we recommend the internal auditor should focus on, and should really look for. And even from a skill management perspective, what we suggest now, and which I myself have been doing, is learning new tools of data analytics is very important. I also had a slide on the new focus areas for internal auditors. Now, if you think about a traditional internal audit scope, you would always think about what we used to do as part of internal audit, is that we would just pick up the trial balance or the financials of the company, see what are the major expenses, major revenues. Basis that we would build a internal audit scope, which would be pretty standard, like revenue, procurement, finance accounts, HR, and all the standard 7 to 8 areas. Maybe 1 or 2 areas additional, basis the industry. But now, with time, with various research coming in, with various surveys coming in for the expectations from internal auditors, there are various areas which can be new focus for internal auditors. Now, it is obviously not possible to do it as the first focus area. Like initially, when you start an audit at a client, probably your initial focus would be to make sure that we have relevant controls in place. But with time, as the internal audit really elevates, these are some of the new focus areas in today's time, which the internal auditors are focusing on. And though with the limited time, I can only brief you about what some of these areas are. If you really go online and do some research on these different areas, you would see that there is a lot of work which internal auditors are currently doing globally on all these areas. And you also, in your respective clients, can think about incorporating this as part of your internal audit methodology. So, one of them is related to the agile internal audit methodology, or I would initially start with the 3 lines of defense. So we all know the concept of the 3 line of defense, and for the auditors, it's important that we assess the first and second line functions in adopting assurance by design, building assurance into processes, and automating core assurances. We should also assist them in understanding tools and methods for monitoring the population of transaction accounts and other data in real time. For us, it is also important to map the organization's assurance efforts in order to locate the redundancies and gaps, and then to help them address that and elevate the assurance fatigue while improving the risk management. So you cannot really say that we should get involved in the first 2 line of defense, which again are very important to the management. But as internal auditors, our focus should be how do we elevate the first two line of defense, so that the pressure on the third line of defense, which is the internal audit, becomes less and it becomes easy for us. If the organization's framework is unclear or weak, the 3 LOD model can be used to strengthen it by clarifying risk-related notes, roles, responsibilities. And internal auditor can not only assist the organization in this area, but lead efforts to clarify, rationalize, and enhance risk governance. The reason this is important is most of the organization you would see, the internal auditors are actually told to focus on the first line of defense. Ideally, the first line of defense are your process owners. The second line of defense are your controllers, the financial controllers, and the internal auditors come at the third line of defense. So whenever you're working in an organization where you see that the first two lines of defense are weak, it is important for us to, point that out and help the management in strengthening the first two lines of defense. The second is assurance by design. So internal auditors, reducing the assurance fatigue by leveraging automation. So I spoke about automation, and this is again linked to the 3 line of defense model, where how can we help the management to improve the automation of the control framework and to bring in new controls which removes the manual controls in the system. If you see, there are a lot of bots and RPAs being used by the clients right now, and the internal auditor will need to learn about the workings and applications of such bots, RPAs, and commit to collaborating with the first and especially the second line of defense, so that the tasks which are very daunting become less daunting. And also, the internal auditor need to seek opportunities to consult on control mechanism that generate greater efficiency other than more work. So these things are again very important as far as assurance by design is concerned. I would also like to focus on the dynamic risk assessment. We all know that before starting off any internal audit or before the internal audit year begins, the internal auditor are expected to do a risk assessment exercise. Basis that they build a risk universe and the audit scope. In today's time, something which has come up is the dynamic risk assessment. So if you can do the annual risk assessment and the annual audit plan by checking and capturing the data of the previous risk assessment exercise, by making all your risk assessment electronic. This would help you in capturing the key KPIs, KRAs of the management, and doing a dynamic risk assessment. Once you have these basics in place, you can consider KRI that would deepen internal audit's understanding of risk in specific domains, such as financial, operational, regulatory, and ways of monitoring trends within the domain. Also, internal auditors need to create a roadmap for moving from the current state to the target state, both from an enterprise and an audit planning perspective. So as the businesses are becoming dynamic, the expectation is that the internal auditors should also make the risk assessment exercise completely dynamic. The next is agile internal audit. So this is something for which I have specific slides, so I'll skip that for now. Sustainability assurance. So again, this is another new area where internal auditors can focus on, which is whether the organizations are sustainable or not. And it will again depend upon the organization's industry, operations, locations, regulatory environment, and maturity of its sustainability management and reporting processes. So some of the mature organizations will have KPIs to review and control, to test. Less mature organizations may lack both of them. In the organizations which lack KPIs, internal auditor can advise management of key risks and opportunities in ways of assessing and tracking them effectively. If you see, sustainability has become a very important aspect. The listed companies also come up with a sustainability report. An internal auditor can actually bring that up as part of their own audit scope and see how risk-related sustainability, for example, the management of the physical and transition risk associated with climate change, for example, have been considered within the organizational risk assessment process. So that can be one of the critical aspects that internal auditors can focus on, and this is something which can give you observations related to the board. The next one is crisis management. So this is again something which is very important in today's time. We all have seen that how COVID has become a huge crisis for all the businesses, and how most of the organizations were not really prepared for a crisis like this. Also, in times like COVID, there has been an expectation from internal audit also to help the businesses to improve and to basically tackle the crisis. So internal auditors in such a scenario can be the eyes and ears of the board before, during, and after crisis event. So before a crisis, internal audit can provide assurance on the crisis management capabilities, auditing against the organization's internal crisis management policy and specific regulatory directions or expectations. If you see in all your clients, ideally they should have a crisis management policy. They should have a framework on how a crisis would be handled. If you see during COVID, a lot of companies and clients face these issues where they were not really prepared. If they would have done a crisis management exercise, they would have had a crisis management framework, those companies would have been better planned. So internal audit should focus on such areas and see whether there is a crisis management framework or not, and also evaluate the maturity of the exercise. For example, a single team tabletop discussion versus a multi-team dynamic solution for the crisis management. Also, when a crisis is occurring and during a crisis event, internal audit can provide resources to support logging, recording, and helping raise awareness for the crisis. For example, in some of our clients during COVID, we were actually helping the clients in addressing the COVID situation and helping them gear up and prepare for resuming their business post the lockdown was lifted. So during a crisis, also internal auditors can play a role because they have better understanding of the complete business than what a particular department would have. Post the crisis, internal auditors can conduct a review to identify root cause, event impacts, and response effectiveness, and also to prepare appropriate reporting to the board. So once the crisis gets over, internal auditor can also prepare a report to the board addressing issues like how the crisis was handled and what better steps can be done in the future. Next is AI and RPA. So again, artificial intelligence and RPA initiatives are being taken up by most of the organizations. And for internal auditors, one is very important to upskill ourselves, to understand what these terms are, what are these technologies, and also to train ourselves to be able to audit things like AI and RPA. If you see, there are organizations which are now completely automizing and using robotics as part of their billing exercise or as part of their master management exercise. Now, to able to audit that, it's important for us to skill ourselves to learn these skills. That is where, because if we are not able to audit such RPAs or AIs which are being implemented with clients, there can be huge issues. So again, RPA and AI become an important aspect where we need to train ourselves. Cloud assurance. So again, most of the organizations now are moving to their cloud model. They are moving their data, ERP, backup to a cloud. And that is where migrating to a cloud model is introducing new and incremental risks. These are the risks which internal audit must evaluate, develop an understanding of alignment between the organization cloud strategy and overall business and IT strategy. This is again more focused on the IT audit part of things, but as the reliance on the data is becoming more and more important, it is important for internal audit also to review such initiatives being taken by the management and to see how the governance aspect is being taken care of when such initiatives are being taken up. Next is the enterprise risk management, and the term which has come up now. So obviously all of you must have heard about the term enterprise risk management, but now the EERM, Extended Enterprise Risk Management Assurance, is something which has become important. So as internal auditors, we can review the business's approach toward EERM. And one of the critical aspects that when I talk about extended enterprise risk management is the third-party life cycle, which is how the need identification is being done, vendor selection is being done, contracting, onboarding, monitoring, and renewal termination of the contractors. Why it's important is because the third-party risk that the organizations are facing right now are becoming pretty grave. We all have seen that during COVID situation where there were organizations which were focused on supply from China or some particular territory suddenly had issues where their supply stopped coming in. Now, if these organizations would have done a complete enterprises exercise and analyzed the third-party risk, probably they would have had mitigating controls or mitigating steps that they could have taken when such a situation would have arisen. Apart from that, things like information security, anti-corruption, business continuity, these are also some of the areas which can be taken up as a part of the ERM assurance. The last one is payment technologies. So if you see most of the clients, especially the ones which are involved in consumer businesses or otherwise also, are moving to digital payment methods. The days of having payments only through checks or bank transfers are gone. You have modern methods of payment being implemented at most of our clients, and that is why it is important for IA functions to also keep pace with the risk associated with this rapidly changing and more real-time and data-rich payment ecosystem. Today, if you see in a consumer business, there would be lakhs and lakhs of payment transactions being recorded on a daily basis. Now, these are not your old times where we can review each and every check and do a basic reconciliation and see whether through a bank reconciliation statement whether the payments are matching or not, because there's so much of data which is being generated. So we also need to use a lot of data analytics, modern techniques to make sure that the risk associated with such payment technologies are being taken care of. So cyber should be a focal point, and we should focus on including implementation of strong customer authentication in response to regulatory requirements. Because if you see, a lot of frauds are coming in today's time is related to payment technologies. So again, internal auditors need to focus on how they are managing the risk or related to the payment technologies also. So these are some of the new focus areas for internal auditors. So what can be done as part of your study or as part of your risk assessment exercise is that you can look for such areas, read more about it, and see if some of these can be implemented or taken up as part of your internal audit reviews with some of your clients, especially the large ones. So the next slide I have is again related to IA transformation. So if you see on top of the screen, there are three aspects which this slide talks about. That is assure, advise, and anticipate. Uh, Traditionally, the role of internal auditor was limited to the assure part of things, where we were just assuring that things are going right, controls are in place, processes are in place. With time, what happened was that the element of advice came into the internal audit scope, where the management started, expecting us to advise them on what needs to be done, what can be done, what can be improved, identifying cost leakages, things like that. Now, the third aspect which is coming in is the anticipate aspect, whether internal audit can help client anticipate the risk which the business will face in the coming years. If you think about it, most of our internal audit reports are based upon past data. Take the data of last 1 year, 1.5 years, do some analysis, and showcase our hypothesis to the client. But if we really do a deep dive into the processes, and if we are able to anticipate the future risk, if we are able to anticipate some of the risks which the business will face in the next 1 year or 2 years, that is what will really, elevate your internal audit report, and that will what will interest the board and the audit committee. For example, in some of our clients, we have done a thorough process of understanding and given them risk and observations related to the business being focused on certain set of customers only, or certain geographical areas only, or having dependency on certain government regulations. Now, these are anticipatory risks where we are saying that, look, right now your business is doing great, but in the next 1.5 years, you might face some problem because this key customer of yours is actually going through a tough time. Now, that is the anticipate part of things where internal audit is not just relying on the past data, but it is risk sensing and learning the future aspect. So, anticipating aspect is something that internal audit needs to bring on. And if you look at this one slide, and especially for those working in in-house internal audit departments or doing large clients, it gives you various aspects like IA charter, risk identification assessment exercise, audit universe, assurance mapping, risk-based planning. These are some of the aspects which ideally need to be there as part of your IA framework for you to perform better and for the internal auditor to have a lot of impact with the board. Things like audit methodology and delivery approach, whether that audit methodology is being implemented or not, whether we have a defined delivery approach as part of internal audit, follow up, something which spoke about earlier, whether we have a proper follow up mechanism or not for critical business issues. There are times where sometimes we give internal audit observations, but then there is no proper follow up on those internal audit observations, and after 2 years or 3 years, we realize that the same audit observations are being repeated. So there's a huge focus now from the boards on the follow-up aspect also. In fact, in few companies, internal auditors are told to have separate follow-up audits where some of the high-risk observations or the high-risk reports, a separate follow-up audit is being done after 6 months. The continuous monitoring aspect. Again, this is something which is important from the aspect of whether the internal auditors are just doing one-time review during the year or are also focused on continuously monitoring transactions. And then the last one is the risk-specific response, that is IT, internal audit, cyber, digital, some things we spoke about, whether internal audit is doing the same scope since many years, but they are really focusing on, getting new areas of audit into their play. What can be some of the digital assets to the internal auditors? The audit management system. So it's important that you have some sort of audit management system which has all your documentation, all your issue tracking in place. Data analytics again is very important. RPA, AI, and all these tools can be used to improve or to support the internal auditors. The skills and capability aspect which the internal auditor should focus on is, how the recruitment is being done, the competency framework. There is a competency framework which is there for internal auditors, and you can build that up for your own department and see whether you have all the competencies in place as far as internal audit is concerned. The third is guest auditor program. This is something which is done in many companies, where apart from the standard internal auditors who go to do the internal audit, they also have a concept of guest auditor, where a subject matter expert from a particular from the same organization or from outside is called upon to do the internal audit uh, with the regular internal auditors. If you see, one of the points which I spoke about is comparing with the industry practices. So to do any such uh, reviews or to focus on any such objectives, it's important to have subject matter experts. So that is where you can use guest auditor programs. You can have rotational programs where if there is you have auditors being bifurcated into certain geographies. The person from geography A can travel to geography B once in a while and do audit there. You should have a learning and development program, a training program, scheduling, how the knowledge sharing is being done between the internal auditors, how the relationship management is being kept with the board. So these are some of the skills and capabilities in today's time which the internal auditor needs to focus on to really elevate his skills. And what can be some of the enablers are agile internal audit, high impact reporting, brand management, response team, change catalyst. Again, this is something which is the new aspect of internal audit, where the stakeholders and the board expect us to also be a change catalyst in the organization. If they are taking some new initiative, let's say some new ERP is being implemented, SAP is being implemented, then the boards are expecting internal auditors to focus on such aspects to help be part of the change, to be a real change catalyst as part of such changes. Apart from that, internal auditors should ensure that they have an internal audit strategy in place. Independence again is very important. How the internal audit is positioned in organization, whether we are being influenced by the management or we have independence as far as our report is concerned. Having a quality assurance program, again, very important, that it should be in compliance with the standards of internal audit, and also peer review being done within our internal audit department, and how we are having KPIs. So I have seen some of the big companies who have in-house internal audit teams also maintain KPIs and performance reporting for internal auditors. These can be an aspect of productivity or strategic KPIs, how many audit issues we had in the previous year, how many of those were high issues. Some of these KPIs are maintained for internal auditors to help them, track their performances and to ensure that the internal auditor also is performing up to the expectations of the board. So this one slide gives a bit of an idea about the whole gamut of internal auditors in today's time. What are some of the specific elements that internal auditor need to focus on? What can be some of the skills, capabilities, enablers which will help the internal audit? And from a function-wide perspective, on what aspect the internal auditors need to focus on to ensure that they add value to the management. So this is again a slide I had on the analytics part of things. So we spoke about the evolution of internal auditor, how it has moved from the traditional internal audit to an analytics-based internal audit. And this slide basically talks about the analytics maturity curve. If you look at this slide, it talks about how the analytics curve has moved in internal audit and can move internal audit from an initial stage where the analytics is being done on an ad hoc basis as a non-repeatable process to a leading phase where it is embedded in a process. You see, in most of the organizations and most of our internal audit reviews, we do a very basic analytics, which is primarily we just use MS Excel uh, to do certain basic analysis. And the only thing which probably it helps to do is it helps in increasing our sample size and test a larger population. But now, if you start improving your analytics capabilities, you could start using other tools like ACLS, for example, one tool, Tableau, Power BI, Alteryx. These are all different tools which are there available in the market, and you can have trainings on them and learn these tools, which would help you quantify the impact and also find out behavioral trends, key dashboards, and all these which you can give to the management, which will add value to your internal audit. This would also help do complex analysis and to ensure that the management defined goals and objectives are being achieved. For example, let's say if, by using all these tools, you are able to give a dashboard to the management about the past 5 years trend of the of the sales of the company, and to give them an analysis about the sales returns continuously increasing, or the returns continuously increasing from a particular set of customers, or some discount scheme not working in the market where you are seeing that the top line is increasing but the bottom line is being reducing since many years. So these are some of the analytics which can probably not be done, not cannot be done by traditional internal audit, but can be done if you have access and if you start using all these tools. This will help you present more value-adding reports to the management, and also help you embed all these tools as part of the processes. Of course, the last is if you have very defined and institutional processes, if you are able to adopt a continuous improvement methodology, and also to evolve forecasting models. So if you are able to implement all these as part of your clients, then that becomes the most leading practice as far as internal audit is concerned. For any analytics tool, the guiding principle are that first of all, you have to define the analytics goal in line with the business objectives. You have to ensure that what are the business objectives, what is the management wants to achieve as part of their business, and your analytics goal has to be in line with those business objectives. Secondly, understanding the data. A lot of time, what happens is we use very powerful Excel, ACL, and tools, but we implement these tools without understanding the data. It's important to understand that the data at a company A will be very different from the data company B. A data in an SAP will be very different from a data in Oracle. So first, it is important to also understand the data to see what are the actionable and measurables that you need to take care of while performing the analytics. Also, to leverage on the existing insights the management already has to make sure that these are relevant to the business, and then to test, learn, and improve continuously. So once you have implemented certain analytics as well at a few of the clients, you can continuously test, learn, and improve the um, analytics implementation to keep on continuously giving value to the management and to improve your internal audit reports. So analytics is one piece where I think if you effectively implement it in your internal audit, if you upskill yourself in internal audit, it will really help you elevating your value addition to the management. The next slide I had, and this is something which we spoke about, and I have also written an article on this in the institute, is on the agile internal audit. So a lot of you might have heard about the term agile. So agile is a term which is used widely in the IT industry, where what they do is they follow agile methodology, where instead of developing a complete, for example, a software is developed, whether instead of focusing on developing the complete software at one go, they break that into various sprints and they focus on smaller goals to achieve the larger goal. Similarly, internal audit can also adopt agile, where it can transform to deliver on a broader set of expectations, providing assurance, but also advising and anticipating risk. What it does is basically, for example, you are doing an internal audit of a procurement function. Instead of delivering a complete report on only a procurement function at one go, what it tells you is by having continuous conversation with the management, you break your internal audit into various sprints, into various phases, and you make your internal audit very agile and flexible to adapt to the needs of the management. It reduces your time between requirement delivery. It builds risk specific insights from the customers, which are your stakeholders. It enhances ability to drive meaningful and high quality insights and meet business commitments by reprioritizing scope. So agile is very important because what it does is in a traditional setup, what would happen is you would begin with a big upfront design and discover through audit report with limited or no overlap. And you would have an audit report which is released as a big bang report. So usually, if you see in our internal audit reports, what we do is we go to a client, we have an initial data request for information, we get the data, we analyze it, we keep on getting observations after observations, and after maybe 3 or 4 weeks we deliver a complete huge internal audit report which might have 20 observations, and we tell the client to give comments for all these observations. The problem with that is suddenly, one, you are giving too much of data to the client at one go to absorb. Second, now at that stage, a lot of time the process owner come up with things where your complete audit report loses its relevance. What Agile tells you is that instead of giving that one big bang report, you break your audit into various pieces. So if you're doing a procurement audit, you do a separate, you do an initial audit of only deal identification. Then you do a separate audit of only, vendor master management. You do a separate audit of only procurement of the purchase activity. And for each of these activities, you call it sprint and you issue your reports as and when you complete a certain sprint. So as soon as you complete one sub process or one sub area of your complete gamut of scope, you issue an audit report for that. And you discuss the observations upfront. What that does is that if there is any issue or any disconnect with the management, you get to hear about it at the first go itself, and you have time to act upon any rework which has been done by, which has been given by the management. Also, you will have enough time to implement the recommendations of the management in your subsequent audits. So Agile helps you to finish the audit also in a timely manner. It helps the team also to be in check because you're continuously, issuing all your observations and all your hypotheses on the go. And the communication and the feedback within the stakeholders and the clients and the audit team, that becomes uninterrupted. The product is released in increments to ensure that the audit of right thing is being done by in the right time. So agile is something which has really come up in the last few years. We have started implementing agile in some of our clients, and we have seen a lot of value, especially the clients which are working in a large setup where there is a large audit team which is working. You can adopt agile and you could deliver high value observations to the client. So this was about agile. Before going to the last slide, I would again come back to the objectives. And having spoken about the various transformation aspects, the various aspects related to agile methodology, the various aspects related to analytics, I would again take you back to these objectives and the value additions which you can bring to the table, where compliance to company policy, philosophy, identification of cost leakages, enhancement of operational system controls, focusing on control validation, comparison with the leading industry practices, focusing on fraud and business process risk, giving an assurance of control design and opportunity for process improvement. These are some of the objectives which you need to keep in mind while implementing things like agile, things like analytics, and to make sure that all your internal audit reports actually are mapping and achieving all these objectives. Another important aspect is also to understand from your stakeholders about what are their expectations from internal auditors. A lot of times as internal auditors, we are guilty of working in silos, but we don't really speak to the stakeholders and we don't really understand from them that what are their expectations from internal audit. This is the reason why once the internal audit report comes out, the stakeholders might not be happy with it because they might be looking for something else and we have been focusing on something else. So regular communication with the stakeholders, understanding their expectations is very important, and also to communicate to them if they are having certain expectations which we cannot meet, if there are certain expectations which are not practical, it's better to be upfront with them and to tell them that, look, this is not something which is part of my scope, or this is not something that I'll be able to achieve. That will help you to have more transparency with, let's say, a board or an audit committee, which expects a lot from the internal audit. This would also help you in upskilling yourself and to see where you need to focus on in the coming years. Obviously, it is not possible for an internal auditor to achieve all the objectives, which I'm showing on the slide, or objectives which are being given by the board. But then we can actually achieve, as much as we can by implementing some of these steps. So this was pretty much it from my end. Before we move to the question answers, Amit sir, anything you want to add?
So I think we have largely tried to cover in this period of about an hour and 10 minutes, more around what are the value add areas and what are the different mechanisms that practitioner can put to use. Uh, Please feel free to ask us any questions that you may have, and we'll be happy to address them. Bharti Garu?
Sir. So members, if you are having any queries or any clarifications, you may unmute yourself and ask the speakers. Else we shall wind up the session.
In case you would like to ask us any questions, even subsequently, our coordinates are available on the last slide, and people can reach out to us.
If you can share the PPT, sir, we shall circulate among our members also.
Absolutely. We'll forward it to you.
I hope no members doesn't have any queries. So I request.
No worries.
Sir?
It has been a pleasure to be here, and please do let us know if you need any help in future.
Yes, sir. Yes, sir. I request Ravi to take over.
Thank you so much, sir. A picture is worth 1,000 words. You gave a deep insight into the new focus areas of internal audit and major components of internal audit functions also. Like transformation into analytics, AI, RPA, 3 lines of defense, and other things. Like the topic presentation was also agile, and it would really help us to build up new areas of practice. Thank you so much, sir. It was indeed a great presentation.
Thank you.
Okay, thank you, sir. And before the next session starts, as still the speaker has to log in, as we have given the time as 11:30 to the next speaker. So as the first session has already ended, I request Swaroop taking this as a advantage to give tributes to all the past chairmen of the Visakhapatnam branch who has made Visakhapatnam branch always active. As every speaker, when we ask to speak for a Visakhapatnam branch, they never say no. They always say first preference is my Visakhapatnam branch, I can't say no. So the standard what they have said to the Visakhapatnam branch is small tribute to all the past chairmen. Thank you, sir. Thank you, Swarup, for that wonderful video. Members, we shall break for 5 minutes till the next speaker joins. Meantime, Swarup, if you are having any videos, you can play. Welcome to our CCM MP Vijay Kumar. Thank you, sir.
Hi, Bharti.
As the first technical session has ended early, so
No problem. Maybe I get
I have troubled you to log in at the earliest.
Sure, no problem. Just give me 1 minute. I think you sent some background. No, you wanted me to use that background.
Yeah, it's okay, sir.
Sure.
Otherwise, you can go ahead, sir.
Because I was just about to do that background setting and you called.
Okay,
if
sir.
you're particular, give me a few minutes. I'll do that background setting.
Yeah, yes, sir.
I'm ready to speak now.
Yes, sir. Yes, sir.
Okay, fine. So we can get started. Okay. So, was there Murthy garu bagunnara andi? Murli bagunnava?
Good morning, Vijay Kumar.
Good morning.
Vijay, hello na.
Bagunnanu.
We'll take a formal introduction first.
So nice to see you virtually at least.
You have to enable share screen for me. It's enabled, no?
Yes, sir.
Okay.
Sir, you can share the screen after your introduction if you don't mind.
Yeah.
No, I just want to test it because now it's not coming for me.
Yeah.
It is saying something.
Now you can try, sir.
Now you have enabled it. Okay, let me try now because it's not coming. One minute.
Swarup, make MPV sir as co-host so that he can share it easily, I think.
Yeah, for some reason it's not coming actually.
Sir, just try now once.
We are humbled to at least introduce you again to the audience. So CA MP Vijay Kumar has been the chairman of the Accounting Standards Board for the Institute of Chartered Accountants of India as the Central Council member now. He's been the member of the IFRS Advisory Council, member for the SME Implementation Group. He's been the vice chairman for the Expert Advisory Committee and the nominee member for SAFA Committee on Accounting Standards. He's been the member of various committees, be it from the Auditing and Assurance Standards Board, Board of Studies, Corporate Law and Corporate Governance Committee, Ethical Standard Boards, and various other committees of the Institute. He has been the resource person for various professionals on accounting standards, IFRS, auditing standards, code of ethics, and more so, all of us know him as a great teacher with over 20 years of teaching experience on subjects of accounting, financial reporting, and corporate law. He's been associated with a lot of associations of the Confederation of the Indian Industry, the National Committee on Financial Reporting, Board of Governors, Madras Chapter, member Board of Studies, ICT Academy, and most of all, NASCOM, member Regional Council. He's been awarded with the National Award for Contribution to Financial Accounting. He's been awarded one of the top 100 Roll of Honor of India and 100 most influential CFOs in India. Having authored various publications to the students with extensive readership and continuous reprints for over 15 years, one of the best experts we could bring on the topic, the authoritative person for the topic today, accounting standards AS 15 and 22. So we welcome you to the AP State Sub-Regional Conference Udbhavi. Thank you so much for giving us your time and hope add some value to the limited experience all of us have as speakers. You may please take over, sir.
Yes, sir, we could see your screen, sir. Sir, unmute yourself, sir. We couldn't hear you.
Sir, you are on mute, sir. Can you please unmute?
Okay, is it fine?
Yes, sir. Yes, yes.
Great. So thank you for those kind words of introduction. Greetings to all, and I trust all of you are safe and your near and dear ones healthy. My sincere thanks to Prasanna Kumar Garu for having invited me to be part of this conference. Of course, today all of us are extremely busy with the examination related work, and Prasanna being part of the exam committee, the workload is enormous, and has been doing an outstanding job there, both in terms of reforms and it's very troubled times now in terms of conducting the exams. In fact, it's a humongous task. In fact, I'm not part of the exam committee, but the extent of workload for somebody not in exam committee is so much. So I can understand how much it is for somebody in the exam committee. And just for the benefit of all of you, all the staff of the institute, all of them without exception, right from the attender, all of them have been put completely on the examination duty. And we're all putting our efforts, counting on your good wishes and blessings of God to ensure that the exams go off well, because there's so many students have been waiting to write the exams. There are few of them who are trying to be a little mischievous, but I don't think we should allow somebody to sabotage. We should look at the students who are preparing well, studying well. I think we are doing this, and as a matter of a beneficial policy, giving benefit of doubt, we are doing something exceptionally in form of a second cycle of the November exams also. I only wish students don't misuse the options, and they stay ethical in terms of writing the exams. I'm confident majority of them will be like that, because all of them are budding professionals and have been trained by the principals who themselves carry good value systems. So I miss him today at this event. Otherwise, I would love to have him as part of the company here. He's been a huge support both in Accounting Standards Board. In fact, 2 days back, he was chairing one of the study group meetings so exceptionally, and he's been part of the expert advisory committee as well, where he contributes well. Thanks, Bharati, and all the other managing committee members for the invite to be here today. And between Prasanna and myself, we thought instead of speaking generally, we thought we'll use the time for sharing specifically on 2 important technical standards. And we zeroed in based on our experience of non-compliances which we come across, particularly whether large or SME, but largely in SME we do come across very regularly. So we decided to do full-fledged discussion on 2 standards, AS 15 employee benefits and AS 22 on taxes on income. Bharti, we have time up to 1 o'clock, isn't it? 1
yes,
o'clock.
Sir. Yes, sir.
I'll plan my time accordingly. I'll try to conclude at 12:45
yes,
and give time for the members' queries as well. So as far as this 2 standards are concerned, before I start introducing them, I'd just like to have this small caveat that whatever I'm sharing here are my personal views and they do not represent the views of the council or any of the committees or boards of the council of the institute I am part of. Some very fundamental things applicable for our profession. And I'd like to read this out because when we understand this, when we try to implement these 2 standards, AS 15 and AS 22 in particular, I think these elements should strongly be imbibed by us. First and foremost, accounting is all about accountability. You need to be answerable. You are answerable. I think we need to recognize that. Accounting is the base for taxation, governance, credit, investment, sustenance of organizations. And ultimately, when as practicing chartered accountants, we express an opinion on financial statements, that opinion is an opinion that financial statements are in compliance with an accounting framework. The opinion says it is in accordance with the accounting framework, and that opinion is a communication. Just like in our personal life, you and me expect any communication we receive to be only truthful and complete. The audit opinion we give, which is a communication, should also be only truthful and complete. And these are fundamental elements applicable for all aspects of our profession, more particularly for some of these complex standards like AS 1522. I'm sure all of you would have taken note of the picture in the previous slide on the left-hand side and in this slide. Both these are publications from the Accounting Standards Board in the recent past, which are meant largely for small, medium enterprises, where one of them is a disclosure checklist. So every audit you do, you can have your staff to check box standard-wise whether they have complied with all the disclosure requirements, which is a publication available online. And this publication, which you see on this slide, is a publication titled Quick Referencer. It's a short publication of 90 pages, effectively A4 sheet. It is only 40 pages. So all the standards have been collapsed into that. And my view, if business transactions are not complex, this publication is more than enough for someone to understand and apply accounting standards. And I would encourage all the staff in particular to read this, useful for exam and useful for performing the work as well. And as practicing members, the quality of work we do is largely dependent on what the soldiers do, what the article students and staff do. So it's important that they have a good understanding of the standards. And that's why we brought out this short publication called Quick Referencer. Now, as far as this standard AS15 is concerned, among all the 28 standards we have, accounting standards we have, the longest standard is the standard 15, which is about 148 paragraphs. The next longest standard is AS 2600 paragraphs, followed by AS 17, some 57 paragraphs. And the remaining 25 standards are maximum 20 to 30 paragraphs, very small. So this standard is quite voluminous. But having said that, it is voluminous because it tries to give so much guidance. But otherwise, the requirements of the standard are fairly simple. And this particular standard replaced the erstwhile standard way back in 1994. And it was very important to have this standard. We are now almost silver jubilee of this standard. Very important to have this standard because I have myself witnessed, and I'm sure there are few senior members today in this conference as well. They would definitely bail me out that around 80s and early 90s, there used to be many organizations which went down the tube. They closed down. Employees are worked for 20 years, 30 years, and they were entitled to get a sum in the form of retirement benefits. Because those organizations went insolvent or bankrupt, those organizations did not have resources for settling the liabilities. So this situation arose because prior to this standard coming into existence, while there was a general requirement of applying accrual concept, most of the organizations failed to account for retirement benefits on accrual. So on the day they shut down, they had assets in books, hardly sufficient to pay liabilities in the books. And there was this very important employees liability, which never appeared anywhere in the books. And I am witness, I have seen many employees for all the 20, 30 years of hard work, thinking that I would get reasonable sum, take care of children higher education, children marriage, or retire a home loan. All those dreams have got shattered, and somebody has to see it to believe it. In fact, there are few standards which make that kind of impact, and this standard is one such standard. So the objective of this particular standard is to prescribe accounting and disclosure requirements for employee benefits. And it requires that as the employees keep contributing to the organization, you recognize the expense for the benefit which organization derives from employees' efforts and keep creating a liability. Some of it is paid immediately, salaries, etc. Some of it is accumulated and paid later at the time of retirement. Some of it is accumulated and paid after retirement in the form of pension. So if somebody is going to earn a gratuity amount of, let's say, 20 lakhs, when he retires at the age of 55, that 20 lakhs is the result of the contribution he has made between the age of 25 to 55. So the expense needs to be accounted during his working life and paid then. Same is true for pensions as well. This particular standard is to be applied by organizations, employers, for accounting for all the benefits which employees get, except share-based payments, for which we have a guidance note as far as accounting standards are concerned. And for Ind AS, we have a standard itself, separate standard. And for some of you here who might be following accounting closely, for share-based payments, the guidance note was recently revised a month back. And I know place like Visakhapatnam and all, now there are a lot of startups, and there are many startups who issue share-based payments to the co-founders and other employees. And for all of those share-based payments, that guidance note is applicable. The employee benefits broadly fall under 4 categories: short-term employee benefits, post-employment benefits. Then we have long-term employee benefits and terminal benefits. I've skipped a couple of slides on definitions in the interest of time, but I'll leave a copy of the slide with Bharti. I'm sure she'll find a way to reach it to all of you. So broadly, 4 categories of employee benefits. Short-term employee benefits are those which get paid as the service is rendered, and those which are payable within 12 months of rendering the service. These typically are your salaries and wages, which are paid on a monthly basis, and the perquisites, etc., which you keep enjoying as you keep working, and the leave-related benefits which you get as you keep working in the organization. Post-employee benefits are those benefits which are paid when an employee quits service, which can be on his retirement or on termination of service, whatever is the situation. Benefits such as gratuity, provident fund, pension, medical care after the person has left the organization, either by superannuation, what we popularly call as retirement, but the technical term is superannuation. Resignation, what people generally use that expression for accounting and even labor laws purpose, it's referred to as retirement. Long-term employee benefits, those are benefits paid to employees for having rendered service to an organization by demonstrating loyalty, working for 5 years, 10 years, 15 years. I recall my father having worked for an organization for 35 years. Current generation might find it difficult to work for even 3 years in an organization. The same is true with many things in their personal life too. They struggle to have relationships beyond short periods. But when we work for such a long period of 35 years, 5th year, for having worked 5 years, they are generally given one watch. And that wristwatch, they take it with so much pride and they wear it for the rest of their life. They won't allow anybody to touch at all. After 10 years of service, you are entitled for some other gift, so on and so forth. And in today's context, I know many of the forward-looking organizations give long-term benefits like you work for 5 years, you can take a sabbatical break of 2 years, do a business school anywhere in the world you want, come back after 2 years. So for 2 years, you need not come to office, but salary will still be paid to you. Salary will still be paid to you. Because you worked for 5 years, I'm giving you 2 years of sabbatical, do some higher education and come. So these kind of sabbatical leaves are given. And there are some organizations which also give breaks like, you contribute with me for 15 years, age of 40, take a break of 5 years. You want to do a PhD, a research, you want to go for teaching, 5 years, do whatever you want, come back after 5 years. So these kind of long-term benefits are being now provided by many forward-looking organizations. Then there are terminal benefits, which happens when you retrench people, you force people to leave the organization, or you run a scheme where you let employees to decide if you want, you quit the job and keep moving on. Those are terminal benefits. So this standard deals with accounting for these four parts: short-term employee benefits, post-employment benefits, long-term employee benefits, and terminal benefits. Of these four, accounting for short-term employee benefits is the easiest, and that's what you and I have been doing all along. No difficulties whatsoever. Salaries as the expense accrues, expense accounting, liability and payment. So no new issues as far as short-term employee benefits are concerned. But when it comes to post-employee benefits and long-term employee benefits, there are some judgments, some estimations which are required for measurement of the amount which you need to recognize as expense and liability. And as these estimates change, how do you address those also needs to be seen. And then terminal benefits when the person actually leaves the organization. So now let me briefly touch upon short-term employee benefits. I'd like to spend a bulk of my time on post-employee benefits, which is the critical part. And I find many, and I'm thankful that many members are here today. Greetings to all of you, and thank you for your time to be here. As far as the post-employee benefits are concerned, my experience, many financial statements, lack of proper understanding, the accounting is not complete. And I'm very confident that once there is an understanding of why it is done in this manner, the quality of accounting will automatically improve. So as far as short-term employee benefits are concerned, as I mentioned to you earlier, these are all benefits which are payable, which is within 12 months after end of the period in which they are rendered. And examples are essentially your salaries which you pay on a monthly basis. And for P&L, the expense is whatever salaries you are paid, no discounting is required. Discounting is a concept which you apply only when payments are made beyond 12 months, where there's a time value impact. So for short-term employee benefits, no discounting whatsoever. And as far as the balance sheet is concerned, the amount which will be recognized in the balance sheet is the expense in your P&L minus salaries already paid. The difference will appear as liability. For example, accounting period April to March. Most organizations, April salary is paid on 1st May, May salary on 1st June, so on and so forth. Most organizations follow this, particularly small, medium enterprises. So for 12 months, April to March, expense will get recognized, but payment would have happened for 11 months. The balance 1 month unpaid will appear as a liability in the balance sheet. Before I go to post-employee benefits, on short-term benefits, I'd like to spend a minute on this. There is what is called as compensated absences. Compensated absences. All of us are familiar with the terms called privilege leave, sick leave, casual leave. 3 types of leave. Factories Act, Shops and Establishment Act, they're all there. Typically, the thumb rule is for each month, it is 1 day of leave. So typically, whichever law, Factories Act, Shops and Establishment, and as general principle, you are eligible for 12 days of privilege leave, 12 days of sick leave, and 12 days of casual leave. So if an employee does not work on these 36 days, 12, 12, 12, even then, he has to be paid salary for that period. So those are called absences for which you have to compensate. Somebody has not come to work, but you would still compensate. Those are called compensated absences. Some absences accumulate. Some are non-accumulating. For example, casual leave. You cannot accumulate and take it to the next year. It lapses then and there. But there is something like sick leave, privilege leave. You are allowed to accumulate. Some organizations, they allow infinite accumulation. Some will put a cap saying that you can accumulate up to 24 days, 30 days. It's an organization policy. Those are called accumulated compensated absences. So I'll sum up till here before I go to the next level. So these three categories of leave, which all of us regularly hear: privilege leave, sick leave, casual leave. Privilege, I'm entitled, I'm privileged because of all the hard work to take the 12 days leave. Sick leave when I'm unwell. Casual leave, just like that, I've got up in the morning, I don't feel like going to office, casual. So this leave of 36 days, compensation has to be paid, and hence it's called compensated absences. These compensated absences are two categories. One is non-accumulating. I cannot carry it forward. If I avail now, availed, otherwise gone. So those are non-accumulating. For non-accumulating compensated absences, there is no separate accounting to be done, because every month the salary you paid included that day also, and no separate accounting is required. It just gets booked as expense. But for accumulated absences, which you are entitled to carry it to next year, in the next year or following year, you may either avail the leave, not come to work next year. You may not come to office next year because you worked in current year 18-19, zero sick leave, zero sick leave. You worked all the days, but in 19-20, you fell ill and took this 12 days also leave next year. So which means in the year 19-20, you did not contribute, but you took salary. So whatever organization pays you that period is because employee worked in 18-19. So matching concept, whatever he worked in 18-19, he is claiming benefit in the subsequent year. Further, it is taking a simple sick leave or privilege leave where you take an encashment. So that leave, which is accumulated compensated absence, you are required to measure, recognize as expense and create a liability. So this is about short-term benefits. And these terminologies, vanilla reading of standard look complex, but they're as simple as what I mentioned to you. I'll repeat the terms: compensated absences, non-accumulating, and accumulating. That's all. Non-accumulating, no separate accounting. For accumulating alone, we need to understand why accounting is required, because I worked in 18-19, but the benefit is coming in later year, matching concept. So that extra work expenses of this year, because next year there is no production related to that. There's no matching of income for that. and hence it is expense of 1819 and not of 1920. So now let's go to post-employment benefits. Post-employment benefits are largely what we call as retirement benefits, provident fund, gratuity, pensions, medical claims, and particularly large public sector organizations, government organizations and all. Post-retirement, you are eligible for medical care for the rest of your life. And that's a huge perquisite. It's a huge perquisite. It's an invaluable perquisite, but that's the benefit they get for the sacrifice they make in the form of relatively lesser income during their working period. These post-employment benefits are operated in one of the four ways. They're operated in one of the four ways. One is called state plans. State plan means government run plan. Provident fund, employee provident fund organization, EPFO of the government. That is a state plan. Second is multi-employer plan. So let's take Tata Group. So within the group or 3-4 entities, they all come together, pool the amount and manage it. So different employers come together, or it can be group administered. So parent company and its various subsidiaries, associates. So at a group level, you are administering it. Fourth option, insurance companies. All of us are familiar. Gratuity. Almost every client has taken insurance from LIC because law requires, not for any other reason, law requires you to go to LIC. If you want to manage on your own, Gratuity Act has a requirement of taking permission and how to manage it. So there are plans offered by insurers. So broadly 4 plans. State plans, all of us deal with it. Provident fund goes to government, that's a state plan. Insured plan, all of us deal with it. Gratuity amounts are paid in the form of premium to life insurance corporation. Multi-employer plans, fairly rare. Group administered schemes are also fairly rare. These post-employee benefits broadly fit into 2 categories. What I spoke, 4 things are the administration, how the money is managed and all. But as far as the benefits are concerned, broadly we have 2 categories of benefits. One is called defined contribution plans. Other is called defined benefit plans. Whether it is provident fund, gratuity, medical, pension, all of them will fit into either a defined contribution plan or a defined benefit plan. As a thumb rule, provident fund, almost all cases, it is a contribution plan. And as a thumb rule, gratuity, pension are all defined benefit plans. I'm using the words carefully because provident fund can also be a benefit plan. Pension can be a contribution plan. But for the purpose of today's interaction and on day-to-day what you and I regularly see, provident fund is a classic example of a contribution plan. Gratuity is an example of defined benefit plans. In a contribution plan, the obligation of employer stops with the contribution which he has done. So if I've contributed 10% of salary, 12% of salary, with that my obligation stops. How that fund is managed, it earns well, some investments go bad, is not the concern of employer. Employer is not concerned with it. All that risk is borne by employee. As an employer, I contribute 10% of salary, 12% of salary, my responsibility stops. Whether employee gets full amount, higher amount, lower amount, employer has nothing to do with it, has nothing to do with the same. As far as defined benefit plans are concerned, these are plans where the amount of benefit is defined by the last drawn salary. So somebody is now working with you at the age group of 25, salary of let's say 20,000 per month. He would be eligible for gratuity when he retires at the age of 55. When he retires at the age of 55, the salary could be 70,000, whatever number. So how much gratuity he will get is based on last drawn salary. So the benefit is defined. How much benefit is defined? So unlike previous one where the contribution is defined, here the benefit which employee will get is defined. So gratuity, your benefit is 15 days salary for each year of completed service. So if I worked for 30 years, last drawn salary 70,000 into 15 by 26, all of us are familiar why 26, into that 30 years is the amount which the person is eligible. Those are called defined benefit plans. And I reiterate, contribution plan can be a state plan, multi-employer plan, insurance, or group administered. In our country, it is largely state plan. Defined benefit plan can either be state plan, multi-employer, insurance, or group administered. In our country, it is largely insurance plans. And these benefits can be in the form of provident fund, gratuity, pension, medical. In our country, largely PF is contribution, remaining are benefit. But please note, there are many examples where provident funds are benefit plans and vice versa also. So this is the introduction. And I'm spending time on this because this is the crux of AS 15. Rest of the standard, I hardly have anything to share with you. Now coming to defined contribution plans. As far as the P&L is concerned, contribution plans, look at the bottom part of the slide, the table, boxes which are there. What to recognize in P&L? In the P&L, the 10% contribution, 12% contribution, whatever is there, that contribution amount is your expense. So whatever you are obligated to contribute, that amount will be your expense to be recognized in P&L. If the contribution is, let's say, 1,000 rupees a month, 12,000 per year, 12,000 is your expense minus what you have paid. If I paid 11,000 already to PF organization, I have 15 days time, balance 1,000 is my liability. That is what will come in the balance sheet. For defined contribution plans, no question of actuarial valuations, no assumptions, nothing. Accounting is as simple as what I just told you. Your contribution which you are obligated to pay is your expense minus whatever you have paid. The difference will be your liability for balance sheet. Now comes post-employee benefits, defined benefit plans. This is the most important part. And I'll go pretty slowly here along with an illustration. And I would request the members to follow the illustration very closely. And the purpose of doing AS 15 here and Prasanna's advice also was that this part is the critical part. For example, gratuity, we come across in the institute disciplinary. Many companies think the insurance premium you pay LIC is the expense for P&L. It is not. What you pay to LIC is the cash paid towards the liability. That is not expense. That is not expense. Incidentally, in rare cases, it may tally, but not so. So I'll go very slowly. There are few terminologies also. All these terminologies are relevant only for this portion. Only for this portion. I'll go pretty slowly. So as far as defined benefit plans are concerned, there's a particular methodology which is followed for identifying the amount of expense in P&L and liability in balance sheet. What you see in the slide here, I will not read out because I'll do an illustration. But just keep in mind, there are 6 items which together go to P&L. 6 items which get combined and go to P&L. Of these 6 items, 4 items come every year, every organization, every client. Small partnership firm, client also you'll have this. 5th and 6th item is little rare. So every year when you're signing off audit report, gratuity expense in P&L, that gratuity expense, the amount has 4 elements, breakup. 4 elements are there. 1, 2, 3, 4, what you're seeing here. Current service cost, interest cost, expected return, actual gains. I'll explain those with an illustration. 5th and 6th come when there are past service costs. For example, if you recall 2 years back, Gratuity Act was amended. Up to 2 years back, gratuity ceiling is 10 years, 10 lakhs. Now it is 20 lakhs. So my accumulated liability was assuming cap of 10 lakhs, but now it's gone to 20 lakhs. So for the past period, my liability has gone up. That's called past service cost. I'll explain that in little detail later. Similarly, any other curtailments or settlements which are done to employees. Typically, any employee settlements and all which are done, how to handle. But first 4 are the most critical ones. Now, for these 4 elements of expense, there are some assumptions which are required to be made, which assumptions broadly fit into 2 categories. Why assumptions? I'll tell you now. Today, an employee with you is at the age of 25 in your firm. You have to pay him 30 years later. So whether this guy will quit your job 7th year, 11th year, 17th year, 25th year, you don't know. You have to make some assumptions. So when you create a liability which I have to pay, I can't assume he will retire only in the 55th when he attains 55 age. He may quit in between as well. So I have to make some assumptions. Similarly, when I make the payment 11 years from now, 17 years from now, the amount I pay at that time, the time value of money today is different. So I pay somebody because he worked for 17 years, lump sum at that age, which that amount is partly year 1, year 2, year 3, etc. It accumulates. The year 1 amount, which is included in year 17, the time value is not the same. So that time value I have to remove. So there are some financial assumptions also we make. So these assumptions are called actuarial assumptions. Broadly fall into 2 categories. One category is called demographic assumptions. Other category is called financial assumptions. Demographic means people-related assumptions. What is the employee attrition rate, retirement experience, how many will be covered by the plan, dependents, all those things. Financial assumptions are the discount rate which I should make, salary growth rate which should be there, and the plan assets. So 17th year money is not going to come from air. That assets I have to create. That assets give me some income. So I have to expect some return on that. So all those things are called financial assumptions. Now, how do we go about this computation? So for this computation, the present value, as I just told you, 17th year I had to pay a lump sum amount, which amount is for 15 days salary of year 1, year 2, year 3, year 4, 15 days salary of each of the 17 years. So that amount I have to discount and find out how much is the charge I have to create. For this purpose, there are several methods which are there. And these methods are quite complex. If it is 3 employees, 5 employees, 20 employees, you and I can do. But if there are large number of employees and all kinds of profiling, it's difficult for you and me to do. And there's a separate science for it called actuarial valuation. And for this valuation, there are 8 methods available. 8 methods. Just like inventory, we have FIFO, LIFO, weighted average, base stock, all these methods. Depreciation, we have SLM, WDV, sum of digits, so many IRR methods, so many methods are there. For actuarial valuation also, there are 8 methods. Just like AS2, does not allow last in first out method. It allows only other methods. Similarly, in AS15, it is ulta, where it says only one method is allowed for calculating liability, which is called projected unit credit method. You can't follow the other 7 methods. So standard allows you to follow only one method called projected unit credit method. The reason is, in the case of stock and all inventory, you can have 5, 6 methods, doesn't matter, because between 2 years, 3 years, they'll all get averaged out. And comparability between organizations is not impacted. But in the case of pension liabilities, post-retirement liabilities, payable after 20 years, 25 years and all, those cases, if several methods are available, the results are likely to be quite different and inter-firm comparability will get affected. So both internationally and in India, only one method is allowed, which is called projected unit credit method. So what does this method say? Look at the example I told you. 17 years. So in that example I gave you, the number of units accumulating to the employee is 17 units. Unit 1, 15 days salary. Unit 2, 15 days salary. Unit 3. So 17 units are accumulating to him. And I am expecting, while he can retire 30 years from now, age 55, my general experience is on an average, 17th year, this guy will leave off. That is why I project my projected units. I expect 17 units to get to his credit, projected unit credits. So 17th year, this is the projected units which are accumulating in his favor. And these 17 units, 1 unit I'll account this year, 2nd unit next year, 3rd unit, and it will keep on accumulating. That is why it's called projected unit credit method. Let me give a simple example. This is not my creation. This is an example from the standard itself. This example is as follows. If salary today is 20,000, with salary growth of 6% or 5% every year, and he has remaining 6 years service. So I joined at the age of 49, retirement 55. So 6 years to go. So based on last drawn salary. So this accumulation of salary at whatever salary growth rate is expected to be 25,500 when he is retiring. And as per terms of employment, he is eligible for 1% of salary for each year of service. Like 15 days salary, here in this example, is eligible for 1% of salary. So last drawn salary 25,500. Last drawn salary is 25,500. 1% comes to 255. And for 6 years, it is 1530. Members, just give me a minute. There is someone repeatedly calling me because I'm in charge of some exam centers. Maybe it's relating to examination. Just give me a minute. I'll take this one call and I'll join. Just give me a minute.
You can please take.
Hello. Hello. One ನಿಮಿಷ. Sorry, I'm back. Bharti, is it audible, ma?
Yes, sir. It's audible, sir.
Thank you. I think today you'll have to just bear with me on this because it's an important day for the institute. Now, coming back here, so 1530 is the total amount in this example. Now, this amount of 1530, what needs to be done is, this 1530 is made up of 6 units of 255. 6 units of 255. Current year 255, next year 255, then 255, it accumulates. So P&L debit, liability credit, P&L debit, liability credit. So you keep accumulating for 6 years. You accumulate for 6 years. But what is important is, this 255 which you pay in 6th year, in today's time value, it is lesser amount. When you look at second year P&L, when it is 5 years away, it is a little lesser amount. So what the standard requires is, find out the present value of what you have to pay then. Today's value of what you have to pay then. So 255, if you discount at 6%, it comes to 191. So first year P&L, I will debit 191. create a liability. But this 191 in year 1, second year, I'm going closer to the time of payment. So one time unit I'm moving, so my interest cost 6% accumulates. Third year, another 6%. Fourth year, another 6%. It keeps accumulating. So 191, next year interest 6%, then 6%, I keep accumulating. So at the end of 6th year, this 199 will become 255 and I will pay it off and I will pay it off. So this is how the accounting is done. So if I come to second year P&L, in the second year, the amount which I have to charge, in my second year P&L will be the unit cost of second year plus the first year interest cost which has accumulated. That interest cost also I have to charge. Recall, I told you earlier that each year expense has 4 elements. Each year gratuity expense has 4 elements. So out of 4 elements, first element is the unit cost. Second element is the interest cost which moves, interest cost which gets accumulated. So together is the charge to P&L. So that's how that cost buildup happens. Now, as I told you, all this looks simple when you're doing one by one. That is why you have an actuarial valuation. This is a beautiful illustration. And as I told you, this is not my illustration, nothing to do with my IQ. It is all available in the standard. I have put it in a little organized form. My contribution is only putting it in organized form and some coloring. That's all. Now, we'll use this illustration and understand how we determine gratuity, which you have to take it to balance sheet, how we have to determine the amount of expense to be recognized in P&L. So discount rate, we have to assume what is the relevant discount rate at each year. In this example, we are assuming discount rate of 10%, 9%, and so forth, so on and so forth. As the interest rate scenario changes, discount rates will also change. I'm sure all of us are familiar with that. Expected return on plan assets. Each year, whatever liability I create, that will accumulate and I have to pay. But where will I get the cash? I'll get cash only if parallelly I build the assets also. I'm sure all of us are familiar with the sinking fund model, where you create and you also invest. So you have this plan assets. So these plan assets will earn something. So to the extent you earn something, to that extent expense is less. Recall I told you 4 elements go to P&L. One element is your unit cost. Second element is your interest cost, which is adding. Third is this plan assets give you some income. To that extent, your cost reduces. That's your third element. So there's an expected return. When you invest in various government securities, you expect at this rate, if I get, it will be enough to pay that 1530. So you make that assumption. Current service cost in this illustration, 130 lakhs or crores, whatever. This 130 is calculated based on actual valuation, what we have to pay, then present value per unit. Like our previous example, this 130 is like our previous example, 191, like that. It's a discounted amount. Second year unit cost is 140. So it is a second year unit cost, 255, previous example. Present value, similar amount is this 140, which is called current service cost, 140 lakhs, 140 crores, whatever. Benefits paid means as the employees leave, you have to pay them. Cash has to go out. Contributions paid means what you are paying to LIC, what you are paying to group plans, what you are paying to multi-employer plan, the contribution, cash paid, present value of obligations, actuarial valuation, all the liabilities, there's an actuarial value. And for plan assets, assets which you have accumulated over time, market value of the plan assets, government securities, whatever you have invested, that fair value is your plan assets. Remaining working life, average employees are expected to be there for next 10 years. These are fundamental assumptions. I will walk you through first column. I will walk you through. Second column, I would sincerely request all the members participating here, you make an effort of how those numbers are flowing in. It will be there in the slide, but you make an independent effort. First year, I will do. Second year, you can walk through. One more slide on assumptions. Assumptions, one more slide. 1st April 2006. Recall this is for 3 years. Recall this is for 3 years. So assumptions, 1st April 2006. In that particular year, the opening plan assets, 2006-07 is the first year. Opening plan liability is 1,000. Plan assets is also 1,000. So which means as at beginning of the year, the liability is fully funded. Liability was 1,000, assets also 1,000, it is fully funded. Second assumption, in the year 2007, second year, 2006-07 is first year, 7-8 is the second year. In the second year, there is a change in the benefits to the employees. So gratuity, for example, instead of 15 days salary, let us assume it becomes 16 days salary, 16 days salary. So because of that additional 1 day benefit, your liability increases. So there are some 5,000 employees in your organization. All of them are now eligible for some 1 day extra benefit calculation. Now, because of that 1 day extra, in this example, the liability has increased by 80 lakhs, 80 lakhs. This 80 lakhs has two components. One component is out of the 5,000 employees, 4,000 employees have already completed 5 years of service, and leave their job tomorrow. I have to pay them. So this extra benefit, entitlement has come to the employees now itself. If they quit now, I have to pay. That benefit is vested in them. That is called vested benefit. The remaining 1,000 employees have joined in the last 1, 2, 3, 4 years. The remaining 1,000 employees have joined recently. They will get the benefit only after they complete 5 years. So in this backdrop, for that particular set of 1,000 employees, this illustration assumes that on an average they have worked for 2 years and there is 3 more years to go. And for the 1,000 employees, the incremental benefit to be paid is 30 lakhs and there is 3 more years they have to work before they become eligible. So AS 15 says out of 80 lakhs, 50 lakhs for the 4,000 employees who have already finished 5 years work experience, they are eligible today. Today, if they leave, they have to pay. So I have an obligation to pay now. So that 50 lakhs, I should treat as expense immediately. But for the 30 lakhs, for the remaining 1,000 employees, there is 3 more years of time. So that 30 lakhs, AS 15 allows you to amortize over a 3-year period. So you can write off over a 3-year period. You can write off 10 lakhs, 3 years. So that is regarding the defined benefit plan illustrations. Let me come to the calculation, how that calculation works. As I told you earlier, 2006-7 I will do, 7-8 you please make an attempt and you will get complete understanding. After this, there is nothing in AS 15. I'm jumping to AS 22. So now 2006-7, please follow the numbers carefully. I hope the slide is visible to all. 2006-7, opening liability is 1,000, plan assets are 1,000. Recall our example. I told you, assumption is at beginning of the year, liability and assets are same. Liability 1,000, assets 1,000. Opening liability means it is for past accumulated one, past accumulated liability. Now on 1,000, I am now moving 1 year closer. So there is an interest cost. Recall our illustration. Interest rate is 10%. Recall our illustration. Interest rate is 10%, discount rate. So apply 10%, it will come to 100. Then recall illustration. Current service cost is 130. So 130 I have to add. Liability has gone up. So current year my liability is increasing by opening liability, one time zone and current service cost. So 100 plus 130. 100 plus 130. Then some employees have resigned, retired and all, for whom I have to pay. Recall illustration, 150 is the benefits paid. So out of the accumulated liability, whoever is left, 150, I have paid them off. So the balance available to me is 1,000 plus 100 plus 130 minus 150 is what is my liability, 1080. I now do an actuarial valuation, and according to the actuary, because of employees' age profile, salary growth rate, etc., etc., he tells me, recall illustration, he tells me that the liability is 1141, present value of obligation, 1141 is the liability. So according to me, it's 1080, but actuary tells no, your liability is 1141, which means I have an extra liability. Extra liability means cost, expense, cost, 61. This 61 is the balancing figure. 10680, which I have calculated, and closing present value as per the actuary 1141, balance 61 is the liability. Please give me a second. Yeah, Bharti, audible? Hello, Bharti?
Yes, sir, you are.
Yeah, I think you have muted everyone along with me. Okay.
Yes.
Yeah, no problem.
It has been checked out.
Yeah. So I'm back. Okay. Now you can mute the others. Now, as far as, sorry. So as far as 61 is concerned, there is a balancing figure, which is the incremental cost loss. Just remember that number 61. Now on the plan assets, opening plan assets are 1,000. And when I invested in government securities, etc., my expected return was 120. Some government securities are fixed income, some are floating rate, some are whatever different instruments. My expected rate was 12%. Recall the illustration. 12% is the expected rate. So on 1,000, my income is 120. Income is 120. And during the year, cash received is 90. Employer has paid cash of 90. What is paid to insurance company? 90. 90 is the cash paid to insurance company. And from the plan assets, cash is paid to employees who have left the organization. 150 is paid. Liability reduces, assets reduces. Liability reduce, asset reduce, 150. So plan assets figure is opening 1,000 plus 120 plus 90 minus what you have paid, 1060. The market value of all the plan assets is now 1092. So as per arithmetic calculation, it's 1060, but market value is 1092. So 32 rupees benefit is their gain. So now please watch carefully. Liability side, we had a loss of 61, which is called actuarial loss. Plan assets, you have a gain of 32, which is called actuarial gain. Net loss 61, gain 32. So the net loss, cost, net loss, please watch my words carefully, cost is 29. Recall I told you gratuity expense, 4 elements. First is current service cost. In this example, 130. Interest on the opening obligation. In this example, 100. 130 plus 100 minus income from plan assets. In this example, 120. And fourth element, I am introducing first time. Fourth element, actuarial gains or losses. In our example, 29. 61 loss, liability side. 32 gains, income side, asset side. Net is 29. These 4 together is the charge you have to make to P&L. Charge you have to make to P&L. And also please watch this slide carefully before you go to next slide. Plan liabilities is 1141. Plan assets is 1092, which means you have unfunded amount. Liability 1141, asset 1092, unfunded liability. The difference amount of 49 will be your unfunded liability, which will be there in your balance sheet, which we will see in the next slide. Now, this slide is what you actually deal with in your audit. Balance sheet figure is 1141 plan liability minus fair value of plan assets. 49 is your balance sheet figure. That's your balance sheet figure liability. How much will go to P&L? Recall I told you 4 elements. For P&L it is 130 current service cost. Recall previous slide 130. 100 minus 120 income. And 29 is a loss. It adds. If it's a gain, it will reduce. Loss. Put together 139 is debit P&L. So what you and I normally do in our audit is debit P&L 139, credit liability 139. But please note, most often we just take actuary report and pass an entry. But as auditor, we are responsible for satisfying ourselves on all these 4 elements. Now this 139, expense debit, liability credit. Out of 139, I have paid insurance company 90. So the unpaid amount is 49, which will appear in balance sheet. which 49 is nothing but difference between plan liability and plan assets. This is how the entire defined benefit plan operates. So I'll now do the second year. But my sincere request is, you please do the math. You please do the math. The difference for second year, I'll tell you what is the difference. The difference for second year is this bottom part of the illustration, this bottom part. So if you look at the bottom part, this part, change in plan benefits. So second year, extra liability of 80 lakhs, liability goes up immediately. Out of 80 lakhs, 50 is my immediate expense, 30, I will account it as expense over a 3-year period. 10 this year, remaining 20 is a deferred expense, which I'll write off in the subsequent years. This is the extra element. So which means when it comes to P&L, cost to P&L, you will have 6 elements. 4 elements plus vested benefits, full 50, and unvested, non-vested portion, you will get 1/3 of 30, which is 10. So with this backdrop, I would request you to please do the illustration yourself as I take you through. Recall these numbers, 2007-8, 9%, 11%. Just keep this somewhere at the back of your mind. 140, 180, at a high level, keep it there. Now, let's do 2007-8. In 2007 and 8, the opening liability is 1141. Opening liability is 1141. Previous year closing is current year. Plan assets opening is 1092. Closing of previous year is opening of current year. Liability side movement. Interest element, current service cost, interest element, current service cost, and additional benefits, vested and unvested, benefits paid, gratuity paid to people, balance is 1284. As per actuary, based on revised demographic profile and all, he tells your liability is expected to be only 1197. 1197. As per my arithmetic, it is 1284. Whereas according to him, it's 1197, which means there's a lower liability. Reduction in liability means gain. Reduction in liability means gain. So I have an actuarial gain of 87. Liability has come down. Asset side, opening assets, return expected, cash contributed, LIC payment, 180 paid to those who have left, balance 1133. But market value of my bonds, government securities and all is only 1109. As against 1133, it is only 1109. So my assets value has come down. There's a loss. That is called actuarial loss of 24, balance figure. So in this illustration, second year, 87 is the gain and 24 is the loss, which means for second year, you have an actuarial gain. You have an actuarial gain 87 and 24. That difference, whatever is the arithmetic, which comes 50, whatever number you get, okay, 57 or whatever number. Now, just do a math. How much is the charge to P&L before you go to next slide? If you get that math correct, you are there. You are there. For second year, P&L figure will be, I hope you are one step ahead of me, 140 plus 103 minus 121, income from investments minus 121, actuarial gain. Gain means reduction in your cost. Gain is 87 and 24. Hopefully, whatever number it is that number you take 63. 63 is your gain. And past service cost, 50 will come immediately, and 1/3 of 30, 10. All put together, you will get some number. That is what will go to P&L. And that number either Bharti or Shruti will tell me now, before I go to next slide. Who is telling? Shruti, I thought you wanted to tell. Okay, in interest of time, I'll move. So as
Sir,
far as...
excuse me, we are just arranging for the examination committee arrangements.
Okay, no problem. You take care. Okay, no problem. So coming to this slide, 7-8 figure, the balance sheet figure will be liability 1197 and 1109, and 20 of deferred expense, net 68 will be in the balance sheet. For P&L, recall I told you, current service cost, interest cost, deduct income from investments, deduct gain, actuarial gain, 50 rupees of vested amount, full amount, 10 rupees of unvested. So total charge to P&L is 119. 119 debit, liability credit. This will go to P&L. And in the balance sheet, there is an opening liability of 49. Recall previous year, 49 is your opening liability. Current year expense, liability credit 119. LIC payment 100. Net liability for balance sheet is 68. This 68 is nothing but difference between plan assets and plan liabilities. This is how the standard operates. This is for deferred benefit plans. I hope it is helpful. So this is how, these are the elements. I've reproduced that slide. So long-term employee benefits, other long-term employee benefits. Recall that example of watch, sabbatical leave and all I gave. For other long-term employee benefits also, the standard says, only 2 paragraphs. It says, follow the same policy of measuring what you did for defined benefit plan. Some people will work for 5 years, some will work 10 years. Do actuarial valuation, identify the amount, recognize in P&L and go forward. That is for long-term employee benefits. So long-term employee benefits, there is nothing new. The methodology is same as what you do for defined benefit plans. So interest of time, I'm moving this out. Termination benefits, that is when you ask employees to go, retrench, or there's a VRS plan, employees put in hand. Those cases, whatever is the amount you have agreed to pay, recognize as expense, liability and payoff. Rarely, there will be termination benefits where the benefit is 50 lakhs, but you tell employee that I'll pay 20 lakhs now and 30 lakhs I'll pay over the next 5 years. Rarely you will tell. Suppose it is like that. Then standard says, for what you are going to pay beyond 12 months, find out present value, recognize as expense, keep accumulating interest and pay. So that is about termination benefits. So disclosures, they're fairly exhaustive disclosures. My very sincere appeal to all members is, please use the AS disclosure checklist book. The disclosures of AS 15 are extremely poor, Please don't get me wrong. All of us crave, literally we crave for respect from all stakeholders and the government and regulators in particular. when MCA and other regulators put before us balance sheet and tell, standards say so much disclosures, only so much is there. As an institute, you are remaining silent. It puts us in a very, very defensive position. So for us, at that time, it's so difficult, but it hurts the overall stature of the profession. My sincere request is, please ensure full compliance, because you and I want respect from all of these people. Respect means complying with the standard. It's as simple as traffic signal. When there's a red, if you stop and then go, there is respect. If you don't stop, violate and go, you can be in a BMW or whatever, it doesn't matter. People will only disrespect. Same thing here. Once there are standards, they have to be complied with in full to get the stature. AS 15, disclosures are minimum 2 pages. That's a thumb rule I can give you, just to ensure that you have covered enough disclosures. Absence of these disclosures, strictly speaking, leads to disciplinary action. Today, it really doesn't happen, but times have changed. My request, please be cautious on disclosures. So all these disclosures are required, and I've taken you through in detail. And I've given in this annual reports of couple of companies. Unfortunately, these are for Ind AS companies, but whether it is Ind AS 19 or AS 15, the disclosure requirements are similar. Just look at Tata Motors. I'm just moving the slides and the disclosures are still coming. So it's a fairly exhaustive set of disclosures which are there. So I'll now move to AS 22, accounting for taxes on income. As far as AS 22 is concerned, the standard is a landmark standard, and thankfully it came into existence from 2000. Had this standard not been there, the number of cases which would have gone into insolvency will be far, far, far more than what we have now. Unfortunately, as far as deferred taxes are concerned, many have this impression that deferred tax is a notional tax liability. It is hypothetical. It is a book entry. I'm sorry. Deferred tax is real tax liability. Deferred tax asset is a real tax asset. There is no notional or virtual about it. It is real tax liability. The moment you understand that it is real, my view, compliance will automatically happen. Interest of time, I have 2 illustrations, but I'll confine to one illustration. I'm sure the other you will be able to follow. Once conceptual clarity is there, rest automatically fall in place. Let's take an example of an entity which is in power generation, electricity, windmill, whatever, solar. Cost of windmill is, let's assume, 1 crore, 100 lakhs. Tax rate, including surcharge, etc., is, let's say, 40%. For books, depreciation straight line 5 years. For tax, depreciation is 100% in the year of installing. So this is illustration, basic facts. Please register these numbers. 100 lakhs, tax rate 40%, depreciation for books 5 years, illustration. For tax, 100% in first year. Now, P&L, illustration, P&L. Assume I have only one windmill. Weather conditions being same. Quantum of power generated year 1, Year 2 is the same. Operating expenses are also negligible. Power rate being same. So both years quantity of wind generated same, rate per unit same, expenses negligible. So let's assume PBDT 100, both years 100. Please follow carefully. Depreciation for books SLM, first year 20, second year 20. Profit before tax 80. How much is the tax I have to pay to government? Cash. I have to pay to government tax, which is called current tax. Calculation of current tax is as follows. Profit before tax, add depreciation as per books, deduct depreciation for income tax. In our example, fully in first year. Taxable income first year 0. Tax to be paid to government also 0. Second year taxable income is 100. No depreciation. Tax payable to government 40. So first year 0, second year 40, and I bring it to my P&L. So in the P&L, recall, PBT is 80. Tax is 0. Second year 40. So net profit available for dividend, etc. and all is 80. Second year is 40. Everything remaining same. Same capital employed, same revenue, same PBT. Net profit comes down by half. Net profit comes down by half. Why does profit come down by half? Single reason is tax. Single reason is tax. Why does tax behave like this? Tax behaves like this for the following. For books, depreciation is across 5 years, 2020. For tax, it is only in year 1, which is 100. So in the first year, for books 20, for tax 100. So there's a difference of 80. So for tax, you are getting extra expense benefit 80. But this will get reversed in future years. This is called timing difference. There's a difference, but it gets reversed in future. So over the life of asset, depreciation in books and tax is same. Over the life, total depreciation is same, but there's a timing difference. So first year out of 80, at tax rate of 40%, I'm saving tax of 32. So first year I'm saving tax of 32, but second year onwards, assuming same tax rate, I'm paying extra 8 next 4 years. So whatever extra tax I pay next to 4 years is what I saved in the first year, cash flow. So whatever extra cash I pay second year to fifth year is the cash I saved in the first year. So what AS 22 says is cash flow is different, expense and matching concept different. So 32 is your tax of first year. Payment is happening in the future years. So in the very first year, you create a tax liability of 32. And the second year, whatever 40 you paid, it has extra 8 rupees. That extra 8 rupees, you keep reversing it. Reverse the deferred tax liability. So profitability statement will look like this. PBT is 80. Current tax, what you have to pay to government, cash flow, first year 0, second year 40. Deferred tax. It is tax of first year, but I pay later. So deferred tax, debit P&L, create liability. And that liability, reverse it in second year, third year, fourth year. So second year, I'm reversing 8, credit 8. So net profit, both years same. So if you look here, all things both years same. Capital employed same, PBT same, PAT is also same. Tax expense, current tax plus deferred tax together, current tax plus deferred tax together. First year is 32. Second year is also 32. Minus 40 plus 8 is also 32. And that's the beauty of AS22. For me, sometimes it is scaring that before AS22 came, all of us used to rely on this P&L. First year profit 80 becoming 40. Thanks to AS22, profits are all matching concept. So that's the beauty of AS22. And deferred tax here, you would have noticed that 888 which you pay from second year onwards is a real liability. You save first year, but you pay later. So deferred tax is an actual liability, real liability, not a book entry, not a notional entry, not a hypothetical entry. I have an illustration for asset. Interest of time, I'm skipping that. But I'll conclude with this one important slide, which will give you a overall idea of how AS22 is applied. I'm sure rest of the slides will be self-explanatory. AS22 is one of the easiest standards to apply. In your P&L, you end up with PBT, sales, expenses, PBT 100. All of us prepare statement of computation of taxable income, where I start with PBT, add back few items, deduct few items. Add depreciation as book, deduct depreciation as per tax rules, then 43B, this, that, 80IA, all that stuff. So add a few items, deduct a few items. And you get taxable income. On an average, experience of all of us put together, the plus items and minus items are maximum 10 items. 10 items. From PBT to taxable income, plus, minus, is 10 items. So PBT 100, taxable income is 60. On 60, I have to pay tax to the government now. For 1920, I calculate a tax rate, pay it off to government. That is called current tax, debit P&L, The balance 40, which is that plus, minus, 40. In language of AS22 is called differences. These differences fall in two categories. One is called timing differences. Other is called permanent differences. Permanent difference means considered in one place now, never considered in the other place. For example, R&D. For books, I take 100 rupee as R&D, but for tax, you get a weighted deduction, extra benefit. That's a permanent benefit. It will never get reversed. Earlier, dividend income. For books, it was considered. For tax, it was never considered. So these are permanent. They will never appear in the other place. One place it is there, other place it will never come. Those are called permanent differences. Those permanent differences you ignore. No accounting required. But items like depreciation, timing difference. Depreciation both places, but timing is different. 43B, disallowed this year, but allowed next year. So these are all timing differences. So some timing differences give rise to a liability, some give rise to an asset. For example, 43B, expense is disallowed now. So which means I have to pay more tax, but next year it will be allowed when I pay. So the extra tax I pay is a prepaid expense. It's a prepaid expense. It's an asset. Benefit will come later. So timing differences, some give rise to a liability, some give rise to an asset. These timing differences will affect your tax outflow in future years. So timing difference, you calculate the tax using the tax rate relating to future years. That is how AS22 operates. It's as simple as this. So with this, I conclude my presentation. So the slide deck I'll forward to you, which talks about few issues and things like that. But all of that is self-explanatory. I'm extremely happy to be part of this conference, AP Sub-Regional Conference. Thanks a lot for the invite. I'm not sure if my principals are here, Mr. Murthy Garu, VSN Murthy Garu, Vizag, and Mr. Ramji Garu and PS Raj Garu. I'm not sure if they are there. So if they are there, my sincere respects to them. And all the members in the region, greetings to all of you. And thank you all for your patient listening. I wish I could speak for another 1 hour, but I think I need to be cognizant of time. And we seek your good wishes for the institute's efforts in conducting the examination. We are doing our best, and any local negativity, I request you to work shoulder to shoulder with us and help us ensure that the exams are conducted well. We need to look at the children who have prepared well and ready to write. I think it's very important. We have to be empathetic to them. There's some genuine cases of COVID support. We are conducting the exam second time. Any mischief which is there, please guide those students and members on the same. So thank you all. Thank you all.
Thank you, sir. They say it's better than 1,000 days of diligent studies, one day with a great teacher. So you reminded us of our classes, which we had the privilege to listen from you. And thank you for taking the most relevant standards for the day, as the due dates are approaching for the audit. And these are some of the standards which are voluminous, but they require a close watch year on year. And thank you so much for all the time that you took in spite of your schedule. We understand with the exams fast approaching and your presence there. Thank you so much, sir. And I want to take the excuse also, because you were asking some questions in between. We were arranging for the committee members to leave for the exam centers on time. So please excuse us for that. As we now come to the end of the session, thank you so much, sir, again. May I now request our Secretary, G. Vasudev Murthy Garu, to please propose the vote of thanks. And then we further request our Central Council member, CA Prasanna Kumar sir, to give his closing remarks. Sir, yes, sir, you can please take.
Sarup Lera, sir.
Sir, please చెప్పండి.
Sir, Vijay Kumar garu wants to talk to something.
Vijay Kumar sir, if you wish to make some announcement or. One minute, sir. I'll just check if you have been muted.
I think you are muted, sir.
Yeah.
Vijay Kumar sir, you are muted, sir.
Yeah, okay. Mr. Prasanna has been trying to reach. He wants to speak. You have to unmute him. I think despite all the pressure, he's taken the effort to join here. He wants to speak. Please unmute.
Yeah. So I think, thank you, Vijay Kumar. I could not get connected with others. So, Vijay Kumar, last minute I joined. When I was just explaining AS22, I joined. Simultaneously, I was just attending to all the calls and listening to your presentation also. So, members, welcome back to Vijay Kumar. మన ఊరు వాడు మన ఊర్లో మాట్లాడడం చాలా ఆనందం అతనికి. మేము ఎప్పుడు అనుకుంటూ ఉంటాం. సో మన ఊరు విశాఖపట్నం హ్యాస్ ప్రొడ్యూస్ 2 సెంట్రల్ కౌన్సిల్ మెంబర్స్ అని, విజయ్ కుమార్ అండ్ ప్రసన్న కుమార్, ఇద్దరు కుమారులు అక్కడ ఉన్నాం అనమాట. సో అదో AS22 ఉన్నప్పుడు ఎప్పుడు కూడా, when it was introduced in 2002, I read so much of stuff that time to understand it. I never understood. Somebody explained me in the seminar. It could not get into my mind in 2002. Then somebody told me that there's a book written, First Lessons of Accounting Standards, a book written by Vijay Kumar and Dan Sadhyanu. There are only 2 things which made the difference in AS22. Pay now, save later, save now, pay later. That's all. Simple. I understood the entire thing. I became a teacher now on that. I used to get many chartered accountants how to compute this particular deferred tax liability or asset, as the case may be. So that is the type of knowledge he has. So I wanted to join the beginning also. As you know, I've been held up in the examination duties, so I could not join. At least now I got an opportunity to say hello to Vijay Kumar, so virtually. Vijay Kumar, thank you, Vijay Kumar. Vijay Kumar, mute చేసినట్టున్నారు.
Vijay Kumar గారు unmute చేయండి సార్. సార్ Vijay Kumar సార్, you please unmute yourself.
ఇప్పుడు వచ్చింది.
అది విజయ్ కుమార్. సో ఎప్పుడైనా నువ్వు మాట్లాడినప్పుడు చెప్పకుండా నేను ఉండలేను కాబట్టి చెప్తున్నాను. ఈ కౌన్సిల్ లో కూడా చెప్పాను. ఐ టోల్డ్ అబౌట్ ఇన్ కౌన్సిల్ మీటింగ్ ఆల్సో.
Thanks, Prasanna. Actually, I was speaking at the start about your contribution, and today the examination అంతాను. In fact, చేస్తుంటే కూడా ఒక సెంటర్ నుంచి కాల్ వచ్చింది మధ్యలోనే. అంతా అలకెట్ చేస్తారు కదా మీరు పని. కూడా అబ్జర్వర్ దొరకలేదట. సరే, I was requesting all the members for their prayers for the exams. And so much of efforts the exam committee members are putting through, because for confidentiality reasons andru pancheyalem. So it's only exam committee members. It's a humongous work they're doing, and prayers will make a difference. Thanks, Prasanna, once again for the opportunity. Very, very kind. Thank you.
Thank you. Very nice.
Deeply humbled.
Yeah,
thank you, sir.
Shruti, untanamma. I am logging off.
Yes, sir.
Back to
please
my
log off.
Okay.
Yes, sir. All the Central Council members for taking your time. You may please log off.
Okay.
Thank you so much.
Thank you. Thank you.
Thank you, sir.
Thank you.
Vasudev Murthy garu, can you please propose the vote of thanks for all the 3 days?
Chairman of the Visakhapatnam branch of SIS of ICA, CA G. Bharti Devi, beloved Central Council members, our Prasanna Kumar garu and Vijay Kumar sir, and today's resource persons CA Amit Kumar Gupta and Ankur Gupta, esteemed senior members, MC members, and past chairman, MC members of other branches of Andhra Pradesh, and my dear professional colleagues. Good afternoon to all of you, and it is a great privilege for me to express my vote of thanks on behalf of the Visakhapatnam branch. I give as the secretary of the branch, I deem it to be a great honor to propose vote of thanks to all who have helped us in making these 3 days sub-regional conference Udbhavi rising with glory such a resounding success. At the outset, on behalf of the MC and on behalf of myself, I would like to express our deep-seated gratitude and thanks to all the dignitaries who joined and graced the sub-regional conference Udbhavi rising with glory, and for their thought-provoking addresses and as well as for their truly inspiring words. We would like to thank our distinguished and eminent speakers for all the 3 days for their excellent presentation and demonstrating challenging issues and enriching knowledge and value addition to our members. We would like to express our profound gratitude to our Central Council member CA D. Prasanna Kumar Garu for being a mentor for the entire conference. We also thank once again our regional chairman, CA Dungarchan Jain, and the SIRC for having given us the opportunity to hold this AP State Sub-Regional Conference and graced the occasion and sharing worthy thoughts with us. And we also thank all our past chairmen, especially CA PVSP Kumar Garu, for his unstinted support and cooperation for day in and day out. I also thank our past chairman, CAG, all the past chairmen and present chairman CAG Bharti Devi, whose brainchild, Udbhavi, Rising with Glory. Really heartfelt thanks to Madam. I also thank our Master of Ceremonies and past chairman CA Lelita, CA Shruti, CA Ravi, CA Prashant, and especially to CA Swaroop, whose extended all technical support and background music. I also thank all our staff members for their hard work and cooperation. And last but not the least, I also thank all the participants. I also thank one and all. Thank you very much, sir. Thank you, madam.
Thank you so much, sir. Thank you, and thank you for all the participants for all their active participation in the AP State Sub-Regional Conference Udbhavi. Thank you. We take your leave.